This Protein Report interview is brought to you in partnership with the Brave New Meat podcast. For more interviews with entrepreneurs and investors in alt protein, subscribe on Apple Podcast or on Spotify. Before we hop into the interview today, I want to get the Cultured Meat Symposium, CMS 2021, on your radar for October 22nd and 23rd. CMS 2021 discusses the role of cell culture technology and the future of meat, poultry, and seafood. This is the fourth edition of CMS, and it's going to be a hybrid event taking place in downtown San Francisco. And again, that's Friday, October 22nd and Saturday, October 23rd. Keep in mind, in-person seating is limited, so you should book now. I participated in this event last year, obviously virtually, and I'm looking forward to attending in person this year. Definitely not to be missed, and it's got an amazing lineup of speakers focused on the scalability and sustainability of cultivated meat. And now, turn into the episode today. There is a product out there with a $1.7 trillion market, and the current means of manufacturing can't keep up with the growing demand. We'll have to make 70% more of this product by 2050, and as wealth continues to grow around the world, we'll have another 1 billion consumers that can afford and want this product. And changing the means of manufacturing it is central to the zeitgeist of the massive changes required by our global economy to combat climate change. The first and second of three waves of technology to disrupt the means of manufacturing this product currently have less than 2% market share in the US, but they are growing rapidly. The third wave is on its way and will be here in the US within the next 18 months. If you're even a casual observer of the show, you know what I'm talking about. Meat. And those waves are plant-based, fermentation, and cultivated. It's a massive challenge to our world, but it's also a massive market opportunity. But talk to the 10 smartest people you know that are not in this alt protein bubble, and other than being vaguely familiar with Beyond Meat or Impossible Foods, they're going to have absolutely no idea what you're talking about. And from my perspective, that's information asymmetry. Most of us were not able to participate in the tech revolution that's happened over the last 20 years, and we now all have a supercomputer in our pocket and able to instantly communicate, talk to a stranger, get them to pick you up in their car, take you to another stranger's residence, where you have a room to stay in their home. If this sounds very strange to you, it shouldn't, because it's Apple, Uber, and Airbnb. But the world's changing. There are a handful of ways for us to get involved in the food revolution before all the major players are publicly traded companies. And one of those is Eat Beyond Global, a Canadian-based investment firm focused on alt protein and available to retail investors as a publicly traded equity. And my guest today is Michael Aucoin, CEO of Eat Beyond. In this episode, we talk about why people are so excited about the investment opportunity, where he sees the world's protein going in the next 10 years, and details of their current portfolio companies. Now, disclaimer, I am not a financial advisor, and the show should not be taken as financial advice. This is for informational purposes only. I'm a guy with a podcast. You should speak with your financial advisor before making any financial investments. And now, on to the show. And Michael, welcome to Brave New Meat.
Thanks, Doug. My pleasure.
Hey, thank you for coming on the show, and very excited for this opportunity to speak with you. And I know you guys have had a lot going on in Eat Beyond Global, but before we get into the company and the portfolio and all those topics, I'd love to hear a little bit about your background and how you got into the alternative protein industry.
Yeah, I mean, for me, career consumer packaged goods guy, kind of with a number of tier one companies, the Campbells, the Smuckers, the Hershey's of the world. But for me, as I've evolved and matured, there was an inflection point a few years ago where kind of my wife and I, we realized on a personal level, that we weren't making the right dietary choices. So we started modifying our diet at that point and reducing the amount of red meat for sure. And gaining an awareness of that. And having worked most recently in the dairy industry, I was actually competing somewhat with, protein alternatives, but also gave me a real instance, an up close look at both sides of that coin. And it allowed me to really witness not only consumer enthusiasm, but the investor enthusiasm around the space. And the momentum that's coming. And I think, we're on the cusp of a material consumer shift over to alternative protein, plant-based protein. and made me passionate about pursuing an opportunity to join that ride. And so that's what brought me to Eat Beyond.
And with that, this is a relatively new role for you. So can you talk about that journey of how you've taken the reins at Eat Beyond Global as the new CEO, or relatively new,
Yeah, yeah. So yeah, I transitioned in about 6 weeks ago, and building on the success of my predecessor. So left on good terms. What it was just a bit of a pivot, as we realized, and I'll talk, as we go through this, we'll talk a little bit about our strategy. But going from more of just a straight investment profile to being more active with our portfolio companies. I think the board was trying to broaden and deepen the expertise in our C-suite with regards to operations, particularly as we're investing in early stage companies. And those companies, fabulous ideas, fabulous inertia, momentum, and passion. But in some cases, with entrepreneurs that aren't fully multidisciplined in terms of their background, they may be tremendous product developers, marketers, manufacturers. And what we want to do as we evolve at Eat Beyond is become a much more active partner with our portfolio company. So bringing in somebody with a rounded out background from a CPG perspective, who's kind of seen it all. I grew up on the commercial side, sales and marketing, but I spent a reasonable amount of time now with significant manufacturing experience. Allows us to better partner with those portfolio companies and really help them accelerate. So I think that was part of what had the organization saying, what's that next, evolution of our leadership, and then the team they had already assembled, quite frankly, for me was attractive, particularly the chair of the board, Don Robinson, who's an icon in the marketplace up here. Opened my mind to understanding what the possibility was.
Very exciting. And looking back to the origins of the company, can you talk a little bit about how the company was founded? You said you're getting more into the operational sort of active investor role, I guess, but what was the original founding story?
Yeah, so the founding story is a group of investors behind this who are public market guys, who realize that there's a tremendous amount of retail investor enthusiasm about this space, but that really don't have access to these early stage companies. It's typically done through venture capital funds or private equity funds, where the barrier to entry is hundreds of thousands of dollars in some cases for an investor to participate, and the retailer investor doesn't really have that opportunity. So the vision was to create that opportunity for the retail investor to participate in this space at an earlier stage. And then what we have the ability to do as Eat Beyond is just give them access to those companies at that earlier stage. So that gives access to the investors. But then what we do from an innovator standpoint, from an entrepreneur standpoint, is we come with significant assets that help them accelerate, expertise in all the functional disciplines of the supply chain and sales and marketing that help them accelerate as well. So it was that those public market guys that created this vehicle that at the outset was modest, but we're growing pretty rapidly. We've got a prospectus out for our next round of financing that will allow us to start to play bigger roles in deals as they come along, participate in larger deals, but also play bigger roles within the individual portfolio companies.
And regarding access for retail investors, and this is very exciting, I think, for a lot of the folks that listen to the show, because as you mentioned, there's not a lot of vehicles to do this. And you guys are based in Canada. Is this easier to start? Because I'm not aware of any fund in the United States that's set up this way. Is this easier to do in Canada than it would be in the US? And then our US retail investors, do they have access to invest?
Yeah, so U.S. retail investors absolutely have the opportunity to invest. So we trade in Canada, but it's cross-listed in a couple of places. The Canada, the Canadian markets and the Canadian regulators deal with companies on a slightly different scale than the U.S. We've got 1/10 the population. So the regulators are a little more nimble in terms of supporting smaller companies and in particular startups. So not only do we see, quite frankly, ourselves, and we're innovative in the way we're approaching this. There's not a lot of people doing it the way we're doing it. But even if you look at on the Canadian exchanges where the emerging plant protein companies are, and alternative protein companies are, a lot of them are listed in Canada simply because Canada works better with companies that are smaller in scale at the outset. We're always interested as we grow, we'll be looking to uplist in terms of different exchanges, but Canada, just from a regulatory standpoint in general, is an easier place to operate from that perspective. It's important to understand that what differentiates us from just an investment fund is that part of our mandate is that we are active in terms of advising very directly with a lot of our portfolio companies. And so the regulators look to us to maintain that as part of our mandate, which is a little bit different than your typical just investment fund.
Got it. So actively involved in, as you alluded to earlier, the operations. And, I've had a lot of Canadians on this show, not necessarily investors, but companies definitely. And one aspect of becoming an entrepreneur in this industry in Canada is access to grant funding from the Canadian government. It seems like a very attractive place to start a company in the alternative protein sector.
Yeah, the government is active on a couple of fronts. So the federal government put in some broad sector funding in a number of sectors where they realized Canada wasn't overly competitive a few years ago, but one of them was plant protein. So that's attracted a lot of investment, and the provincial governments tend to be reasonably active as well. I think I believe in the U.S. there's access to some development funding as well. Maybe not quite as prevalent, but certainly it helps people give a bit of a leg up or a bit of security as they go into it, knowing that there's a stability in some funding there.
Mm-hmm. And when these retail investors are getting involved, are there common shares versus preferred shares? Is there any other sort of nuance of when they are buying a share on the Canadian stock market?
Yeah, no, I mean, the concept of preferred and common shares exists in Canada, but with Epion, we're straight common shares. There's no different classes of shares with different rights. It's a share is a share is a share.
Got it. So available to retail investors on the Canadian Stock Exchange. Shares are common shares. So with that kind of background, let's dive a little bit into the investment strategy or thesis. How would you articulate that?
Yeah. So, this is a minor pivot as I joined the organization, because I think if you look at our portfolio now, the broad thesis you can intimate from it is a bunch of stuff operating in the circular economy. But I think as I arrive, we look at it being the real opportunity. The enthusiasm from a consumer perspective, the enthusiasm from an investor perspective is really displacing animal protein. Mm-hmm. And I see a tremendous amount of growth. We're on the cusp of a tremendous amount of growth there. So we're looking to kind of hone our future investments. We're going to work with all our current portfolio companies. We're happy to have them. But as we look to future investments, it's going to be really focused on displacing animal protein. And then beyond that, I think what we do with our model, which is heavy involvement, particularly from an advisory capacity. In some cases, we're seconding people in on even on the payroll at a more tactical level. People that we know of quality that we can put into an organization for 6 months, a year, full time to help them accelerate. And so what we're targeting with our investments in portfolio companies is companies that usually already have a product developed, maybe a smattering of a distribution that we can help them rapidly accelerate, whether that's Canada and the US, because we've got some capabilities there as well. And then all equally from a manufacturing perspective. So a lot of these things have started up as virtual cottage type industries. On a small scale, but without a real industrialization plan. And we come in with certainly knowledge, skill set, but also partners in that space. So with some of our portfolio companies that we've been operating with in a very rapid fashion, we've set them up with material capacity to service a lot of growth that would have been hard to unlock with even just significant investment money, but without the expertise that comes with what we bring.
Yeah. And when I've looked at media talking about you guys, as well as on your website, the word plant-based comes up a lot, but I know you're also invested in fermentation and cultivated meat companies as well. What's your thoughts, or how do you view those different verticals? Are you still going to actively pursue all three, or are you coalescing around one or two of those?
As I said, it's really about displacing animal protein, and then I look at, as we look through it, is what's the path to commercialization and significant growth, and then a monetization event, whether that's an IPO or selling out to a strategic. It'll be around what's our ability to really accelerate that time frame. I think if you look from a consumer perspective, plant-based is broadly accepted. Fermentation is not as well understood, but not I would say not spooky. And interestingly, we certainly have some investments in cultivated. I think cultivated long term is the sound play, and will pay off. But whether that's in the next 2 to 5 years remains to be seen. I think there's still some consumer hurdles with their acceptance of that and understanding what is lab-based meat, just at its core. And then depending on the process from a lab-based perspective, there are a couple of hurdles also where some of them are starting with stem cells and those kinds of things, which really don't deal with the animal welfare issue very well, quite frankly. So those need to be managed. At term, lab-based, lab-grown meat should have a cost advantage, but again, that'll be fundamentally dependent on what are the rents charged with the IP attached to it, because it's the one where you can hang a lot of IP. Whereas when you get into plant-based, there's a little bit of IP, but it's not as predominant in the P&L. I'll put it that way, as we're expecting to see in lab-based. And if the cost of the technology remains high, that'll be a barrier to growth.
Yeah, I think in a lot of the conversations I've had with entrepreneurs doing cultivated meat, the IP and really protecting that and being very concerned about, either in collaboration or working with universities, almost at the risk of slowing the industry down, right? Because, they're trying to do everything in-house. Just wonder if you have any comments or thoughts on that.
Yeah, I think it's a real risk in helping some companies in some other spaces prior to this. I think as you were partnering with some universities, their requirements around IP ownership or participation in IP ownership would be onerous as these entrepreneurs are trying to create that value for themselves. For me, it's a whole other level of complexity to navigate, but it's also, once it's established, if you have rock solid IP, it becomes a revenue stream unto itself and a source of value unto itself. So that, the rewards there once you get there, trying to navigate that is an interesting challenge.
Yeah, definitely. And I want to speak to, I'm going to share in the show notes, but you guys have an investor deck on the website, which is great. I want to get a little clarification because it mentioned something, and please correct me if I'm wrong here, but returns of 20% plus and management buybacks. And then I'm viewing this through the lens of how I hear venture capitalists talk about, we're looking for a 10x, 100x return, IPO acquisition. It seems like a very different strategy. I wonder if I'm misreading that, or if you can just characterize it a little more.
Well, and an accurate description lies somewhere in between the two. With 20%, one of the things about being a public company open to retail investors, I think we want to be deliberately conservative as we set out what our expectations are for financial performance. Mm-hmm. Simply from the standpoint of, we're not a typical public company with a product that has an ongoing revenue line. We are making investments. We'll be generating return on those investments on a periodic basis that may not be every single quarter. Once the deal flow gets up and running, that'll be a little easier to establish. And I think as we look at that acceleration phase, the amount of value creation is going to be similar to the venture capital. As we IPO companies, it'll be an inflection point for us to consider what do we do with that in our portfolio. In some cases, we'll retain a piece of that in the portfolio, and once you get to IPO, you don't get the same 10x. The market outcomes will taper off, but still have tremendous growth opportunities, I believe. So what we'll be looking at in the portfolio at that time is, are we going to hold materially the entire piece of our equity in those? Will we wind that back somewhat to recycle the capital to go back in and accelerate new investments? or in some cases we may exit entirely. Obviously, if it's a sale to a strategic, we're likely to exit entirely. As you know, not only will likely they want to buy out 100% of the shares, but not only that, the benefit of what we do in terms of our advisory services, if it's a large strategic multinational that's buying it, our services are less relevant there.
Right. Yeah.
Yeah.
They know what to do with it at that point.
You'd hope so.
If they're buying it as a strategic acquisition,
Yep.
they should know how to manage that.
Yep.
That's great. And then in those instances, you have a liquidity event like that. Is the intent to return a dividend to any shareholders, or would it be to roll that into new purchases or somewhere in between?
Yeah, or for the foreseeable future, it's certainly just to roll into new activity with new portfolio companies. As we grow, we've got the ability, one, to take a greater participation in individual deals that we definitely want to have the ability to do. And then as we continue to grow, we'll start to build out our advisor base that'll give us capacity just to manage more deals. So, you know, at some point, 3-5 years down the road, if we've built a significant amount of capital, could that change? Possibly, but for the foreseeable future, the plan is just to recycle the capital into new investments.
Gotcha. And then when you are looking at companies, you know, you mentioned early stage, you've got some other companies that are, you know, more mature. You know, Eat Just comes to mind. Obviously, they're the only ones to market with a cultivated meat product. So you got this full range of different companies, and then you got different technologies too, as you said, plant-based, not as much IP, cultivated meat, more IP, a lot of different technical things to consider. So kind of breadth and scale of the companies, there's these variables. How do you do the due diligence on such a wide range of things?
Yeah, I mean, you know, I'll say broadly, and having come from a large corporate background, when you get into the startup space, the due diligence is a little bit different. I mean, so you know, and in particular with the startups, so you'll do all the correct due diligence from a financial perspective, making sure they're not laden with debt or any strange covenants in their in any kind of prior shareholder deals, those kinds of things. But if you're passionate about the idea and you think they've got a good idea, and in particular, you know, and not that this would be a traditional formal part of due diligence, but if you can, you know, to the extent you've got an entrepreneur who's ready to work with the structure you're proposing, and that's an important thing for us. The due diligence is pretty simple. As you get into larger organizations that have been through multiple rounds of funding and you know, have properly, you know, financially audited, properly audited financials, the due diligence can get a little deeper, and you know, along those lines. But when we're with some of the startups that we've been dealing with that are very small, the due diligence process can be pretty quick.
I'd love you to elaborate on strange covenants that you might have seen in your career as you're looking through this. What's an example of something that you peek under the hood and like, ooh, maybe not?
Yeah, I'm smiling because I'm dealing with one right now that I'd rather not talk about. That might be something we want to cut. You know, when you go into it, I think with us, part of our process is we'll come in with initial investments, you know, and with a plan to grow with that portfolio company. And to the extent that there might be any restrictions on those in further on investments as we continue to grow and put a lot of resources in, because as Eat Beyond shows up, yes, you know, we come with you know, with financial support, but what's important is we're investing our time with our advisors. And you know, our advisory model is kind of interesting because the way we do it is as they participate in our portfolio companies, we give them equity participation in Eat Beyond and equity participation in the target company. And when it works, can be quite lucrative for them. So the fact is as we look at potential portfolio companies, if there's a hindrance to that future equity participation due to any kind of covenants with prior shareholders, you know, right of first refusals on investment, those kinds of things, that tempers our appetite a little bit, because, you know, it's not, the initial investment can sometimes be quite small as we're helping them get out of the gate, but it rapidly proceeds when we start talking about things like industrialization, manufacturing. Those kinds of investments rack up pretty quickly. And if we're not participating in that to the same extent we participate in that initial investment, we bring It's just less appetizing because we don't get the broader returns on a larger piece of our portfolio.
So is the concern there that you're worried about being diluted in follow-on rounds, and you want to ensure that doesn't happen?
We're okay to be diluted in following rounds, which is as part of the math happens. I think what we're concerned about in some cases where we've seen prior investors have the first right of refusal on any future investment, which means we can't deploy additional capital in to support our base investment and can't generate those ongoing returns. So if I'm going to generate a return on an initial small investment, that's great. But because I'm investing so much of my team's time, I'd rather be able to add to that investment and generate the additional returns on those investments, because it's generating the return on the people time that I invest in.
Gotcha. And so it's interesting to me that someone investing in a company like this would want first right of refusal, because presumably you want the follow-on rounds and you want folks like yourself coming into a later round.
Well,
why would they structure a deal that way?
Yeah, I think they do. I think they do it to protect themselves from dilution. Funny enough, right? So it allows them to say, "Hey, we've got the financial capacity to continue to invest, and if we think the terms of the investment are attractive, we want the right to do it prior to bringing in a new investor group." So I can appreciate why somebody would want that. With us coming in behind something like that, it's not as attractive.
Understood. Got it.
Yeah.
And stepping back as you're looking over all of these deals that you've got coming in, and the companies out there that are successfully raising and not successfully raising, do you think there's enough capital in all three verticals for plant-based, fermentation, and cultivated meat, where the good quality teams and quality projects are able to raise, or is there still a shortage of funds?
I think my sense, again, I arrived 6 weeks ago. My sense of it as it sits right now is there's ample capital ready to deploy, but trying to figure out what's the best way to do it, and how to bet on those teams and bring out those teams. And again, that for us at Eat Beyond, that's a bit of our core proposal to not only the retail investor, but the investment community. As we're not widely held with institutional investors, but there are a few. Is that not only do we think we'll be a better filter for finding the right investment, but we'll help assure their success with our model of advisory, help and resource help. So, my sense is there's a significant amount of capital that's just trying to figure this space out. It's moving very quickly, and I think that's one of the things when we talk about accelerating portfolio companies, it's important. If you look at dairy alternatives, liquid dairy, food dairy alternatives on the cascade that's gone from rice to soy to almond to oat, for a lot of investors, it's hard to keep up with that. And as you're looking at startups, you need to really have the ability to accelerate and get them to market quickly, because those ideas will flow through. And if you can get them to scale quickly, they can continue to respond to consumer demand. But anyone that comes to us with a 3 or 5 year strategic plan, it's not likely to play out that way, simply because the consumer demand is evolving so quickly in the space that we feel the need to be able to get people to market in 8, 12, 14, 18 months is what we need to be able to execute with them, to be able to capitalize on the initial demand with the consumer where it sits right now. And then from there, once you've got some scale and money flowing through your P&L, you can pivot as those consumer preferences change.
Yeah, I know you mentioned dairy, and that's your background. I was at the Industrializing Cell-Based Meat conference last week, and someone showed a slide of all of the alternative dairy companies out there right now, divided by like the different, whatever we'll call it, the root source of whatever they're using as a dairy replacement. It blew my mind. Like, I knew a lot of these companies, but seeing them all together on a list, and a lot I hadn't even heard of, it's a really competitive space. I know they're just a relatively small segment of the overall dairy market, but there's still a lot of players out there.
Well, and they're regular. Look, it's a relatively small. I mean, relative is relative. Dairy is huge to begin with, so even a modest size participation in that category can lead to some big numbers. Number one, but also it's what's driving the growth. And when you look at it from a retailer perspective, Retailers are working on such low growth rates and low margin rates that they're always trying to capture that new consumer that's looking for those innovative products, and they get tremendously excited about it. So, dairy alternative as a section is probably over skewed and over shelved in the grocery store, but that's because retailers are trying to figure out how to capture that. And right now, as I arrive and have had chats with some retailers, they're trying to figure out, what do we do with plant-based? How do we properly incorporate that in our stores? Do we create a plant-based section, or there's so much of it now, it's growing so quickly? Do we just throw it in line in every section? And they're struggling to figure out how to best meet that consumer need. And they want to, each and every one of them, again, it's an exciting, skewing younger consumer. They all want to dominate that consumer. So they're all trying to figure that out. And it creates a lot of opportunity, a lot of innovation, and, a lot of startup activity in the space.
I'm smiling because as a consumer, I think I experienced this in my grocery store. So we recently just moved, and I went into the new grocery store, and I found the plant-based section, right? Plant-based meats, and it's in its own section. And then down around the corner, I find the exact same foods in another section. So that they're basically placing them in both. And presumably, I guess they're just trying to figure out, like, hey, where's the best fit for this in the store? But yeah, it's kind of scattered around. And the same thing with their plant-based or non-dairy ice cream. It's in two sections in the grocery store, like radically separated. I guess they're just trying to figure out where's the spot for this stuff.
Yeah, the issue at term with that for retailers is the cost of inventory is so high that maintaining two locations is, you're just carrying more inventory that you need. And as again, their margins are reasonably tight. That it'll be interesting to see how sustainable that is, particularly as plant-based continues to grow in its offering. We're in the early days. Burger and beef well established, chicken kind of coming through. Everyone's working on trying to figure out bacon, and other products. But as the technology starts getting better, and we start seeing it multiply through the store, they won't be able to maintain that dual distribution. And interestingly enough, and I lived through this earlier in my career in other categories when organic started, and retailers had the same struggles: was, do we create an organic section, or do we put it in line with all the regular categories? And that was reasonably easy because organic wasn't big enough in terms of breadth of item to, at the time anyway, that it was easier to create a section. But now the retailers are, again, it'll be interesting to see how they play out, and we'll see different strategies with retailers. Some will create a section and try and market around, we've got this great plant-based section, and some will put it all in line, but then try and highlight how they're supporting it across their store. But they're all, again, I think they're all pretty enthusiastic about plant-based.
Well, taking that view and let's go fast forward 10, 15 years. What does the grocery store of 2031 look like?
In 2031, okay. Look, I think what we're rapidly moving towards is a tipping point on plant-based, where we start to see economies of scale. So the traditional animal protein categories and industry has been built over a century, and benefits from tremendous economy of scale. So as we see plant-based right now, not particularly cost effective, getting there on quality in terms of product delivery. I think as we get to that tipping point of achieving scale within plant-based, and it'll be interesting to see what brands emerge as big brands. It'll bring the cost of plant-based down. If you just think of the cost of rearing an animal for whether it's a year, 2 years, 3 years, 4 years, to produce what the economic benefit is, because that can be replicated much easier with plant-based. So as plant-based gets scale from a processing perspective, better systematic growing of the crops and harvesting of the crops, I think there'll be a definite cost advantage. And I think so we'll see a consumer move for health reasons and animal welfare concerns to plant-based. I think the animal protein categories in 2031 will certainly exist. In 2050, I think they'll be niche, premium, specialty items that will have lost a lot of that economy of scale. And I think even the big animal protein companies are seeing it. We're seeing them all broadly investing in this because they've seen the writing on the wall that this is a trend that isn't going to go away, and they need to protect their future by investing in plant-based. But yeah, that's kind of what I see is it'll be niche, premium. what's left of the animal protein space.
Yeah, I know Tyson's is getting into this space. BRF out of Brazil, they've got a partnership with Aleph Farm, so they don't want to get left behind. They're talking about themselves as protein companies and not meat companies anymore.
Oh, look, we're a member of the Plant-Based Food Association of Canada, and so is Maple Leaf, which is the dominant animal protein player in Canada. They're an 800-pound gorilla, but fine company, fine people, but they're in that space because they're participating in the category, and trying to figure it out, but B, trying to ensure their future with it, because again, I think they see the consumer shifts coming.
Yeah, it's very encouraging and hopeful. Not a lot of good news out there these days, but a lot going on in this sector. So that's promising. Want to dive into your portfolio companies and ask you about a couple of them. First, there's some news out. Nabanti Foods. I don't know if I'm pronouncing
Nabanti.
Plant-based eggs, but there's another company in your portfolio, Eat Just, which I eat regularly. I had this morning. I pretty much live off Eat Just, I think. Also very well known for their plant-based eggs. Is this something that they rolled out after you guys invested, or do you just want to make multiple bets because you think that's a big sector, or what's the story behind both of those?
Yeah, a bit of I think Nabati had designs on plant-based egg prior to our arrival. Our investment there really unlocked their ability to do it. We think it's an attractive space. I think Just Egg and Nabati primarily Canadian. They've got a smattering of distribution in the U.S. and interestingly, they're getting a lot of interest out of the U.S. But at the first instance was setting itself up to set up to serve a Canadian marketplace that was maybe a little bit underserved. And then also looking pretty aggressively into the food service side of the space, which I haven't seen anything around Just being as focused on that space. Our participation with Just goes back a while, and again, given the scale of what Just is, we're a small investor there, but participate with them to be abreast of what's going on, absolutely. And look, we think there's a lot of runway for growth in egg in general. If you think about how pervasive egg is in our diets, not just as a breakfast food, but in baking and again, food service, restaurants, all these kinds of things. There's a lot of room for growth there, and Nabati works on a fundamentally different technology than Just does in terms of what the root crop is and how it's processed and how it performs. So I think Just is a juggernaut that's moving well and growing and doing great work. Nabati's a small feisty startup that's building on a good cheese program, and they've got some vegan cheesecakes as well, and now participating in egg.
Yeah, I'd actually hopped on their website to look to see if they had anything in the U.S. and they do, but unfortunately not in DC. So I think they're coming though. I was impressed with the map. Once you throw it in on the U.S., you can see where all their products are. So
well, look, there's such a demand in this space, and I think there's been. And that's what's driving the demand. The demand is, I'm not sure Just has been able to satisfy all the consumer demand that's out there, and they're ramping up quickly, which is great. But I think Nabati is viewed as a secondary supplier there right now, so I think you'll start seeing more distribution of it as we speak.
How can folks just keep up with you guys? Through your website, you've got a lot of great content on there. Any other social media? How you're engaging? Just how folks can find out what's going on.
Yeah, we've got so absolutely on our website, Facebook, Twitter, LinkedIn. Moderate activity that'll be ramping up more as we continue to grow and deploy more assets. We're coming up to a few events here where we'll have the ability to make some noise about some further investments that we've made that we're pretty excited about, and that'll get the ball rolling on that front. And then just stay tuned, because I think we're I'm loving what I'm doing being here, and we're in an incredibly exciting space. And we're closing a gap in the marketplace, that allows that retailer investor to participate, but also, as we partner with the entrepreneurs, we give them resources they wouldn't have access to with typical investors. And I think, we're going to be generating some news on a few wins upcoming, not new investments, but with existing portfolio companies on how we've helped them accelerate. That will generate significant returns for us, but significant wins for those entrepreneurs. And I think it's going to generate a lot of excitement and enthusiasm for what we're doing.
All right. And the real last question now, because you teed one up, if someone is an entrepreneur and is seeking investment, what's the best way to engage with you?
You can reach out through the website. You can reach out to me on LinkedIn. I mean, it's been one of the interesting things. As soon as I've been announced, I've been receiving investor decks unsolicited and a lot that don't fit our investment profile, but some tremendous ideas out there, which kind of, there's a couple that I've responded to saying, I love your idea, just not a fit, and I've explained what we do. But yeah, absolutely. So whether directly to me on LinkedIn or through our website, and we'll put it in front of our investment committee, and we're eager to help and help entrepreneurs grow.
Fantastic. Well, Michael, thank you so much for coming on the show. This was a very interesting interview. Best of success, best of luck with your success, as well as for your portfolio companies.
I do appreciate it. We're going to have a lot of fun. It's been a real pleasure being with you.
All right. Have a good one.